Infine, per S&P Dow Jones Indices, oggi abbiamo con noi Smadar Shulman, Head of Fixed Income Core and ESG Indices. Smadar è responsabile a livello globale della gestione della strategia dei prodotti della gamma di indici obbligazionari Core e ESG SRI. Ci fornirà un'introduzione alle soluzioni a reddito fisso che possono essere utilizzate dalle compagnie di assicurazione per la gestione delle riserve tecniche e dei prodotti assicurativi, con un intervento dal titolo Navigating Fixed Income with Indices. So, good morning, Smadar. It's a pleasure to have you with us this morning. I leave the stage to you, and your time starts now.
Ciao and good morning, everyone, and thank you, Bruno, and the Itinerari team for having me on today. It's a pleasure to be speaking to you. And as you can tell, I'm doing this in English. So allow me to start by giving a short introduction into our fixed income business at S&P Dow Jones Indices, and then walk you through some case studies, how indices can provide solutions to different situations with an insurance lens. So let's dive into the next two slides. I think that one. Thank you. So for those who are less familiar, we have a global suite of fixed income indices and provide regional insights through our global platform. So we have also a global presence, including in Italy. Our solutions are not only used for traditional benchmarking, which is of course very important, but also our indices are used as underlying for liquid fixed income products for trading, hedging, and providing exposure such as ETFs, total return swaps, and futures. So there's a range of ecosystem around our indices. Our solutions also cover other themes like a range of sustainability solutions and a wealth of customization options around that, whether it's looking at sort of different ESG perspectives, etc. So, and in this scenario, we've also partnered with the different ESG data providers for best-in-class solutions around climate, labeled bonds, and so forth. Let's go to the next slide. Thank you. So we offer a broad suite of fixed income indices with over 20 years experience, and really this is delivering all of that through our various brands, whether it's the iBox cash bond indices, which I'll focus on today, CDX, iTrax. We calculate around 30,000 plus indices on a daily basis. And to give you some numbers, we have around 140 billion of assets tracking our indices on the fixed income side. So there is a wide choice, I would say, of specificity for investors when it comes to fixed income. You can get access to different sectors, maturities, rating slices, and a combination of all of that. And this is fairly standard and exists across currencies as well as different asset classes, for example, in investment grade, high yield, and so forth. And so investors have numerous options to have very targeted, to be very targeted with their allocations. So maybe some piece of information, the Index Industry Association has reported that there's around 250,000 financial indices being calculated on a daily basis, which is a large number, but a much smaller handful of these can really be said to be essential to capital markets in terms of their adoption and downstream trading tools. So building an index is just, is one thing, but building an index with utility is another thing. And so indices are increasingly being developed to focus on their downstream uses, such as ETFs, futures, and the likes that I talked about earlier, and supporting kind of dynamic instruments. And therefore, index design becomes increasingly important. And we broaden from just purely defining the market segments to also looking at other things around optimal index design, balancing considerations across tradability, turnover, diversification, all further supporting sort of efficiently tracking underlying markets. Let's go to the next slide. Thank you. So I've covered a bit of this already in terms of the customization and the ecosystem, but I'll just mention one thing in terms of leveraging. So in terms of fixed income, it's still very much an OTC market, and therefore it's important to have good quality data, and that's something that we pride ourselves in, and we use multi-source and independent pricing as well as reference data, leveraging our internal data sets from another division, global, an S&P Global Market Intelligence. So the pricing and data is sort of a business in its own right, but we leverage it within our indices as well. Let's go to the next slide. Thank you. So I want to introduce you also to SPIVA. SPIVA stands for S&P index versus active. And so what you see, well, this is a research that's been conducted, let's say, we've been doing this for over 10 or so years. And it really seeks to look at, how funds are doing, whether they are outperforming or underperforming their benchmarks as stated. And we keep a track record of that, and we publish this research on an annual basis. And we do this across different asset classes. So we started with equities, and we're now obviously doing this also in fixed income and a range of indices across the board. And what is really interesting to see is that if you look at over time, whilst active certainly can outperform their benchmarks, doing it consistently over time is very difficult. And in fact, most of the cases, this does not happen. So you can look at the trends over, 1 year, 3 year, 5 year on the slide here. And no matter which asset class, really, if you look at, over 5-10 years, the majority of asset managers do not actually outperform their benchmarks. You can look at different periods in time, of course. Last year with volatility and increase in rates and so forth. In this case, the liquid investment grade universe, active managers actually fared better. But over time, if you look at the 5 year, that starts to look at the trend, similar to other asset classes. So, this is a research that we, as I said, publish, and you can subscribe to that, for example, via our website if you're interested. Let's go to the next slide. Okay, so let's look at some case studies. Actually, let's skip through these because this gives you a range of our global indices that I mentioned in the beginning. But in the interest of time, we can go to the case studies directly. But feel free to look at the range in there across both our standard indices as well as ESG. Okay, so this is a yield enhancement strategy I want to introduce you to, and yield is a key consideration factor in fixed income. We had, as mentioned, very low interest rate environment over the last decade or so, and investors wanted to explore higher yielding strategies that would still benefit from the beta of the asset class. In this case, we're talking about Euro corporates. So the solution tackles two objectives. One is, of course, as the name suggests, yield plus. It's a increase return potential by better capturing yields, and we do that by choosing or selecting the top 50% of highest yielding securities in Euro corporates. The second mechanism is to address sort of the negative immediate impact in situations of downgraded bonds into high yield, so for investing grade to high yield. The research has shown that bonds suffer price losses the months before downgrade and downgrade and shortly after. So, but those prices tend to rebound after several months, let's say around 6 months or so. So for less constrained investors, they have opportunity to recoup these temporary losses, so to speak. And so the index allows a certain portion of these downgraded fallen angels, if you like, bonds in the index for a specific amount of time, a maximum 1 year, with a cap of 20%. So, so it kind of addresses kind of this phenomena within the index, and therefore capturing the yield and return potential in the market.
Sorry, Smadar, just to remind you that time is almost up.
Thank you. I'll be brief on the next one. So if you look at the next slide, this is just to give you color. So the previous slide had the returns and yields, so you can, hopefully you've seen the strategies outperform versus the standard Euro corporate index. On this slide, you can see the capital structure. For example, there are increase in triple Bs, as well as lowering or less double A's and single A's versus the Euro corporate index, as an example. Let me go to the next case study and introduce you to exposure to Solvency II corporate infrastructure bonds. And this leverages the SPDJI Global Corporate Bond Infrastructure Index at the heart. So you have exposure to that asset class, but it does it in a unique way, where we've partnered with a third-party independent provider, in this case Deloitte, who certify the specific each specific security to track the qualifying global infrastructure under Solvency II, or that meet the Solvency II criteria under that regulation. And so I guess the benefit is this is a rules-based, transparent exposure to global infrastructure, but it qualifies for the capital relief that you get under Solvency II. This gives you a bit of color onto. Let's go to the next slide to give you color in terms of the sector profile, for example, which types of sectors are in this, as well as the currencies, which is predominantly dollar denominated as well as euro denominated, and similarly from a domicile perspective. If you look at the next slide, shows you historical performance. So it's very much like an infrastructure, access to infrastructure corporate bonds, but of course has varying, slight variation, of course, depending on the market cycle and so forth. If you look at the yields, the next slide, you can see, during sort of COVID, actually these yields on this index, as well as infrastructure, generally had higher yields than the Euro corporate, global corporate benchmark. But those have sort of come much more in alignment over the last year or so. Let me flick through so you can also see sort of different metrics here, and we calculate all of those spreads, durations, and compare that. But let's go to the final case study, which is just really to mention that our indices are used for Solvency II risk-free rate requirements. And as you're aware, EIOPA publishes on a monthly basis the relevant risk-free rates, and these incorporate a calculation of the volatility adjustments.